Okay, let's dive in. We're exploring a trend that's quietly but really dramatically reshaping the financial landscape. Real-world assets, or RWAs.
Yeah, this is where the tangible, the traditional stuff collides head on with blockchain technology, and it's kind of a big deal.
Absolutely. We pulled together a couple of pretty fascinating sources for this deep dive. One gives us the view from the crypto side.
Right, defining what RWAs are, the tech, the key players building this out, and, the benefits they promise.
And the other source looks at the exact same trend, but through the lens of traditional finance, TradFi.
It's all about the disruption, right? The vulnerabilities this exposes in those legacy systems and how the big institutions are trying to grapple with it all.
So our mission today is to basically unpack the most important nuggets from both sides. We want to walk you through what RWAs actually are.
Who is driving this change, both in crypto and TradFi, understand why it's projected for such, well, explosive growth.
And maybe glimpse how it might totally transform global finance.
Yeah, because this isn't just crypto jargon.
Not at all. Yeah. When we talk about tokenizing assets like, say, bonds or real estate, even an invoice,
Right.
and putting a representation of that ownership onto a blockchain, well, that has implications far beyond just the crypto world.
It really does. This could change how anyone invests, how you access capital, or even how you think about owning things.
It's complex, it's moving really fast, and definitely worth understanding.
So let's start right at the beginning. What exactly are real-world assets?
Okay, so our sources define RWAs as basically physical or financial assets that exist outside the digital world.
Things you can touch or traditional financial instruments.
Exactly.
Hmm?
Which are then represented by digital tokens on a blockchain. Think of it like taking something valuable in the physical world or the old financial system,
And giving it a secure digital twin on the blockchain.
a trackable digital counterpart, and the range is incredibly broad, according to the sources.
Yeah, it's everything. Government bonds, corporate debt, real estate, commodities like gold, even industrial machinery.
Or simpler things like individual invoices, outstanding loans. It covers pretty much every major asset class you can think of.
And the market size. The numbers are already significant, but the projections.
Wow. One source puts the current RWA market value at over $39 billion as of June 2025.
And heading towards $50 billion by the end of this year.
But the headline number, the one that really, makes you lean in, is the projection for 2030.
That's the big one. One source suggests potentially $10 trillion?
While the other is even more bullish, seeing a future market worth somewhere between $10 and $30 trillion by the end of the decade.
$10 to $30 trillion. That's a massive range, obviously.
But even the low end signals a monumental shift, right? Where value is going to sit and how it's going to be traded in the, pretty near future.
So how does this actually happen? How does this transition work? What are the core concepts making it possible?
Well, the first source lays out some key building blocks. The most fundamental one is tokenization itself.
Right. Converting ownership rights or the value of an asset into a digital token on a blockchain.
It's like creating a programmable digital certificate for your physical thing or your financial instrument.
Exactly. And to do that properly, you need RWA protocols.
These are the platforms, the networks, designed to handle the whole life cycle of these tokenized assets.
Yeah, from creation, issuance, to trading and settlement, they provide that essential tech infrastructure.
And one of the biggest benefits, especially for individual investors like you listening, is fractional ownership.
Oh, this is huge. Tokenization lets you break down really high-value assets, think a commercial building, or maybe a piece of fine art.
Things most people could never afford outright.
Exactly. Break it into many smaller, much more affordable tokens. So suddenly, investing in things that were previously only for the super wealthy.
Becomes possible for people with, much smaller amounts of capital. You can own a fraction of something valuable.
And once an asset is tokenized, it's not just about ownership, right? It can be used in other ways, like for borrowing.
Precisely. That brings us to collateralization.
Okay.
So tokenized RWAs can be used as collateral in decentralized finance DeFi protocols.
Which unlocks liquidity from assets that were previously just sitting there, illiquid or hard to leverage quickly.
Right. So you could potentially borrow against your tokenized real estate or maybe your bonds without having to actually sell them.
But for this to really go mainstream, especially with institutions, it can't be the Wild West.
No way. The sources really emphasize the need for compliance infrastructure.
Absolutely critical. This means building in layers for things like identity verification, Know your customer, KYC,
Anti-money laundering.
AML, jurisdictional compliance, all built right into the protocols or even the asset tokens themselves.
This isn't optional if you want big money, traditional finance, and the regulators to get seriously involved.
Okay, so who are the players actually building this ecosystem now? On the crypto side, our first source listed quite a few interesting protocols.
Yeah, the crypto native world is just buzzing with activity here. You've got platforms specializing in all different types of RWAs.
Can you give us a few examples from that list just to show the variety of what's happening?
Sure, take Ondo Finance. They're tackling traditional finance head-on by tokenizing U.S. Treasury securities, government bonds.
Okay, so safe, yield-bearing government debt.
Exactly, bringing that onto the blockchain for DeFi users. The source highlights they've processed over $2 billion in tokenized treasury transactions just this year.
$2 billion in tokenized government debt. That's real movement.
It really is. Then you have Centrifuge. They focus on maybe less common assets like invoices or real estate.
Helping businesses unlock liquidity from those kinds of assets using DeFi.
Right. They were pioneers, actually the first to use RWAs to back MakerDAO's DAI stablecoin. The report says they're currently managing about $280 million in active loans.
So you can even tokenize things like future income streams or physical property.
Yeah, going beyond just government debt into more private assets. Maple Finance is another one, specifically focused on institutional lending in crypto.
Lending to crypto firms.
Yeah, providing under-collateralized loans to crypto-native institutions. The source mentions they have $700 million in total value locked TVL, that's the value held in their system.
And they offer things like
Over-collateralized Bitcoin loans yielding around 5.1% APY, annual percentage yield. So catering to the borrowing needs of crypto companies themselves.
Got it. And it's not just about tokenizing the asset, but also the underlying infrastructure.
Right. Like Chain. It's described as a blockchain built specifically for compliant RWA tokenization.
Designed with regulation in mind from day one.
Exactly. They've apparently already tokenized $500 million in Dubai real estate.
Wow, a dedicated blockchain just for RWAs.
And then there's the crucial piece of connecting the on-chain world to the off-chain data.
The Oracle problem.
Yes, which is where Chainlink comes in. They provide that Oracle infrastructure needed to securely bring real-world data like asset prices, maybe audit results, onto the blockchain.
Acting as a kind of universal translator, ensuring interoperability. Vital.
We also saw MakerDAO mentioned again. They're a giant in DeFi and seem heavily involved here.
Yeah, MakerDAO uses various RWAs as collateral to back their stablecoin, DAI. It adds diversification beyond just volatile crypto assets.
Makes sense.
The source notes they have over $650 million invested directly in RWA projects and are generating something like 57% of their revenue from these RWAs now.
57%. That's a serious commitment.
It really shows their belief in it.
And what about for someone, maybe just wanting to buy a piece of property more simply?
Well, Lofty is an interesting one there. Focused purely on tokenizing residential real estate.
Okay.
Their goal is liquid investment in property. No lockup periods, instant liquidity. And the source makes an interesting point that they have no SEC restrictions mentioned.
Potentially a different regulatory path they're navigating.
Could be. It's just incredible, the variety here.
Yeah.
From billion-dollar government bonds down to potentially fractionalizing a single rental house.
And the first source actually breaks down the asset categories being tokenized now.
Right. While private credit and lending is currently the largest chunk by market value, over half the total.
Treasuries and bonds are the fastest growing category right now.
Yeah. And real estate, commodities, equities are also significant areas people are working on.
So with all this activity, what are the big picture benefits? What's driving this momentum? Why are all these platforms and investors flocking to RWAs?
The sources are pretty clear on the advantages. First up, liquidity enhancement.
Turning illiquid stuff into something tradable.
Exactly. Traditional assets like real estate, private equity, they can be incredibly hard to sell quickly. Tokenization allows them to be traded potentially 247 on a blockchain.
And settlement time drops from days or weeks.
Down to minutes. That's a fundamental shift in accessibility.
It really is. And tied to that is fractional ownership, which we touched on.
Lowering that minimum investment barrier. Making high-value assets accessible to a much wider global pool of investors. Truly democratizing access.
And it breaks down geographic barriers, too, you mentioned.
Absolutely. Global accessibility. Tokenization lets you participate in markets regardless of where you live, potentially cutting out complex, costly, cross-border stuff for certain assets.
And blockchain's basic strengths, like transparency.
Definitely play a role. The immutable ledger gives you a transparent, auditable record of who owns what and when it changed hands. That's transparency and trust. Reduces counterparty risk.
And what about cost savings? That sounds like a big motivator.
Huge. Cost efficiency. Automating processes like settlement, compliance checks, management through smart contracts. It can drastically cut the overhead.
Eliminating layers of intermediary fees.
Right. One source estimates smart contracts could save $15–20 billion annually in global infrastructure costs alone.
Wow. $15–20 billion just in infrastructure savings. That number by itself is massive.
It really is. And alongside cost, remember the regulatory compliance piece being built in.
Right. Designing for KYC/ML from the start.
Which paves the way for institutional participation. And then there's leveraging DeFi's potential.
Capital efficiency. Using these tokenized RWAs as collateral.
Exactly. Unlocking capital tied up in previously illiquid assets, integrating them into DeFi for lending, borrowing, yield generation, and more.
And ultimately, the goal is making finance more inclusive.
Yes, leading to greater financial inclusion. Lowering minimums, costs, geographic barriers. It means more individuals around the world can potentially access investments and credit that were just out of reach before.
Okay, so those benefits sound incredibly compelling. But for every advantage tokenization offers, our second source argues it shines a pretty harsh light on weaknesses in the existing system.
Yeah, let's flip the script now.
Let's look at how this RWA growth is seen from the perspective of traditional finance, TradFi. Because this isn't just some niche thing growing on the side.
No, that second source really drives home the point. This RWA trend isn't happening in a vacuum. It's a direct challenge to the very foundations of traditional financial institutions.
And what's the core vulnerability they identify for TradFi?
Fundamentally, it comes down to inefficiency and this heavy reliance on intermediaries.
Built layer upon layer over decades.
Exactly. Adding costs, slowing things down at every step. Tokenization just automates so much and cuts out many of those layers. The source quotes an industry analyst who puts it very starkly.
What did they say?
Traditional financial markets are on the brink of collapse unless they integrate tokenized real-world assets, which can revitalize liquidity, transparency, and accessibility.
Brink of collapse. There's strong language. What are the specific structural weaknesses of TradFi that tokenization is really exposing here?
Well, the source lists a few critical ones. We already mentioned that potential $15–20 billion annual savings from smart contracts.
Right. Highlighting the high operational costs baked into TradFi's legacy system.
Exactly. That's the flip side of the cost efficiency benefit we just talked about. Then there's settlement inefficiency.
Why does it take days to settle a stock trade?
When a blockchain transaction can settle in minutes or even seconds, that speed difference is a massive competitive advantage for tokenized assets.
And the access issue again.
That ties into limited access in TradFi, high minimum investments locking most people out. Tokenization enables fractional ownership, blowing that wide open.
And all those middlemen taking a cut.
That's the intermediary dependencies. Every bank, broker, custodian, clearinghouse, they all add a layer of cost and time. Tokenization allows for more direct peer-to-peer value transfer, cutting many of them out.
The source also mentioned something about deregulation playing a part, speeding this up.
Yes, it reports that the pro-crypto stance and the push for clearer regulations from the Trump administration could potentially accelerate this shift.
How so?
By reducing some of that regulatory uncertainty that was, maybe holding institutions back before. It's noted just as a factor driving the trend, according to the source.
Okay, got it. So given these vulnerabilities, which specific TradFi institutions are really feeling the heat, according to this source? They seem to rank them by risk level.
They do. The source lays out a kind of tiered view of vulnerability.
Yeah.
And in the most exposed tier, the ones facing immediate disruption or maybe already struggling to adapt fast enough, you have the biggest names.
Like the huge investment banks.
Exactly. Goldman Sachs, for example. Now, they are planning tokenization projects.
What?
But the source points out their focus seems to be on permissioned, private blockchains, which might just be too slow, too closed off, compared to the speed and openness of the crypto-native protocols.
So the risk is being outmaneuvered by faster, more agile players.
That seems to be the vulnerability highlighted.
Yeah.
And JPMorgan Chase, they've talked a lot about blockchain.
They have done trials, But the source highlights them as maybe struggling to scale beyond those pilot programs,
Yeah, and their vulnerability.
tied to the sheer cost and complexity of replacing or even integrating with their enormous legacy infrastructure, plus navigating all the existing regulatory burdens tied to their current massive operations.
Even BlackRock, the world's largest asset manager, they're on this list.
Even BlackRock. While they launched that tokenized fund, BUIDL, it has over $500 million in assets now.
Which sounds like a lot, but
But it's still tiny compared to their $10 plus trillion in total assets under management, their AUM.
right.
Their core vulnerability, according to the source, is potential fee compression across the board, as tokenization just makes traditional asset management potentially much cheaper and more efficient.
And the custodians. Like BNY Mellon, State Street.
Their whole business model relies on holding assets for clients, right? Blockchain's decentralized on-ledger ownership model directly threatens that.
If ownership is tracked immutably on a blockchain,
The need for a traditional custodian holding assets in a vault is significantly reduced, or at least changes dramatically.
okay, moving down the tiers in the source, who else is exposed?
Tier 2 includes other large asset managers, like Vanguard Group. Their success is built on low-cost index funds.
And tokenization could allow even lower cost, more efficient versions of those products directly on chain.
Potentially, yeah, putting pressure on their fees in their whole model. BIMCO, known for fixed income, faces pressure on bond management fees as automated, tokenized bonds become more common.
And European banks. Were they mentioned?
Tier 3 includes major European players like UBS and Deutsche Bank. They are piloting digital bonds, but the source notes they're facing significant implementation struggles.
Their traditional trading and custody revenues already under pressure.
Right. What about private equity? The alternative investment firms, are they safer?
Not according to this source. Tier 4 includes giants like Blackstone, KKR, Carlyle Group, Apollo Global Management.
Their models often rely on packaging private assets, charging high fees for access.
Exactly. And fractional ownership, direct tokenized markets. These could potentially bypass their intermediary role in private credit, private equity, real estate, disrupting their core business.
And finally, the source gets to the actual plumbing of the financial system.
Tier 5. Right to the heart of the infrastructure. Exchanges like ICE and CME Group, clearinghouses like DTCC and Euroclear, and messaging systems like SWIFT.
Their core functions matching buyers and sellers, guaranteeing trades, settling transactions, facilitating payments.
All threatened by decentralized, instant, lower-cost blockchain alternatives. The source does note SWIFT is trying to adapt, partnering with Chainlink.
But its core messaging model is just fundamentally slower and more expensive than native blockchain transfers.
Yeah. It sounds like there's barely a corner of traditional finance that isn't potentially disrupted by this RWA trend.
The source definitely makes that case, highlighting that investment banking revenues actually hit a 13-year low back in 2019, maybe signaling underlying issues even then.
So institutions face a clear choice: adapt or become obsolete.
Harsh, but maybe realistic. So how are they responding? Are they just fighting it, or?
It's a mix of strategies, according to the source. Some are trying the embrace and extend approach.
Like JPMorgan, BlackRock, moving into the RWA space themselves, even if cautiously.
Right. And the report notes that institutional capital is flowing in, helping on-chain private credit grow significantly, like 40% last year. So they are participating.
Okay, so they are putting some capital to work there.
Yes, but the source also highlights that simultaneously they might be engaged in regulatory lobbying.
Trying to slow down crypto adoption through policy influence.
That's what the source suggests. And they're also leaning on partnership models, working with existing crypto infrastructure providers like Fireblocks instead of trying to build everything from scratch internally.
Makes sense. Probably faster. What does the source say needs to happen for these traditional institutions to actually navigate this successfully? To survive and thrive?
It lists 4 crucial success factors. 1. Early blockchain integration into their core systems, not just pilots.
2.
Fundamentally transforming cost structures. They need to shed those expensive legacy systems.
3. Building robust, compliant tokenization capabilities themselves. They can't just rely on partners forever.
And critically, 4. Educating clients. Making them comfortable with the possibilities and safety of tokenized assets.
Okay, let's look ahead then. The source paints a pretty dramatic picture of the transformation to come. What kind of timeline are we talking about?
Well, the projections for how investors plan to allocate capital are telling. Institutional investors expect, 5.6% of their portfolios in tokenized assets by 2026?
And high net worth individuals even higher? at 8.6%. That's a noticeable shift in just a couple of years.
And the source believes the conditions are ripe right now.
Absolutely. It states the recent surge isn't arbitrary. It's happening because everything's lining up. Rules are getting clearer in major markets. The tech is stronger, faster, and ready to scale.
So it's not just tech readiness anymore, it's the regulatory signals starting to align too.
Creating a kind of tipping point.
Yes, that's the idea of the tipping point. As the infrastructure matures, as regulatory clarity improves, the source argues trillions of dollars currently locked up in illiquid or inefficient traditional systems.
You just flood onto blockchains.
Yeah.
Creating this massive new value pool for whoever is positioned to capture it.
And this isn't just slow, steady growth. The source talks about winner takes most dynamics.
Yeah, it's a strong prediction. The source projects that the early blockchain adopters in finance will capture a disproportionate market share.
Meaning legacy institutions could see clients leave faster and faster?
Potentially.
Yeah.
The traditional regulatory advantages or moats they held could disappear as RWA rules become clearer.
And the cost advantages of tokenized systems will just compound, making it incredibly hard for the old models to compete.
That timeline the source suggests for this disruption is quite aggressive.
It really is. Let me recap their projected timeline.
Yeah.
2025, 2026. Pilot programs start scaling up, moving towards mainstream adoption.
2027, 2028. This is when they project significant market share shifts will begin.
2029, 2030. Crunch time. Traditional institutions either successfully transform or enter a period of rapid decline.
And beyond that.
2030 plus ties. The emergence of a fully tokenized financial system.
Wow. So potentially less than a decade until the financial system could look fundamentally different, enabling fractional ownership of pretty much all asset classes.
Right, with programmable compliance built directly into the assets and transactions.
Drastically reduced intermediary fees.
And allowing for direct peer-to-peer transfer of asset value without needing central counterparties for every single step.
It's a vision of finance that's faster, cheaper, more accessible, and truly globally interconnected.
We've definitely covered a lot in this deep dive.
We have. We started by defining real-world assets based on our sources, looked at those crypto-native platforms tokenizing everything from bonds to buildings.
Understood the big benefits driving this unlocking liquidity, fractional ownership, cutting costs, global access.
And then we flipped it, looking at the TradFi perspective. How this RWA growth is a direct threat, exposing weaknesses, putting huge institutions at risk.
And forcing them into this adapter decline situation.
And the key takeaway is, this isn't some far-off future tech anymore. This shift towards tokenized assets is happening now. It's happening quickly.
And it really has the potential to change how you invest, how businesses get funding, how assets are owned, and just fundamentally how we all interact with financial markets globally.